Today on Navigating Retirement, we're going to talk about an extended edition today, guys, on timing the markets. And we're going to have some points and counterpoints, hopefully. And David, we'll start with you on the Santa Claus rally, which is basically November, December. Generally, the markets tend to do pretty good.
Yeah, well, actually, it's pretty appropriate now. And Santa Claus rally, most people would assume or believe that it's 2 to 3 days before and after Christmas that markets tend to be driven up. Now, Thackeray, this is Thackeray's investment guide here, argues that it's probably arrive early and stay late. Santa Claus would arrive early and say December 15th all the way through to January 6th. And so two things basically drive the markets up, and it's a lot of tax loss selling is done the first half of December, and it's people getting back in the market the second half. And then the second thing is, money managers would typically, enter in and lock in their positions for the coming year. Okay. So those two things would be the primary drivers of it.
Jeff, do you believe in the Santa Claus rally?
Not so much.
Not too much? No. Tell us why.
I mean, out of all of the myths, it's probably the most likely one to occur. And there's some pretty straight up reasoning behind it. The tax loss piece, December 15th, up to December 15th or 20th, people can sell their stocks and take their losses to write off against future gains. The problem is if it's been a really good year in the market, there's far less losses. So people find it difficult to find those losses. And typically the Santa Claus rally is 15th, but technically it was from Christmas to New Year's. And the idea was there was that period in a week there where either the institutional guys were resetting and all this stuff, and it was a good opportunity. But what it always led into was as January goes, so goes the year. So given that if we're in the midst of a rally, and typically a rally lasts 3 weeks, how do we get into January and all of a sudden if we have a bad year, the year's going to be bad? So it's not quite as consistent as...
Is there thin trading involved at that time of year too as well?
No, hold on, I want to address this first.
Okay,
I need to deal with this because there's some pretty solid support here. So the S&P 500, they did a study on this from 1950 to 2014. On average, gained 2% and was positive 78% of the time. Okay, the NASDAQ from 1971 to 2014, gain of 3%, so it's a little better, and positive 77%, and it outperformed the S&P 70% of the time. So actually, it's even a better bet. And then the S&P TSX Canadian market, from 1971 to 2014, the gain was 2.7%. And 82% of the time it outperformed, it outperformed the S&P 500 61%.
Okay, Jeff, those are pretty good numbers for a short period of time.
They're not bad numbers, but let's step back from that number and let's call it 3% or 2.5%. Great. Now what we're doing here is we're short-term trading. So if you're in a fee-based account, wonderful. That doesn't cost you anything. If you're paying commission, costs you at both ends. Any gains are going to cost you tax, and not only that, they're going to cost you tax in the current year, not after January 1st. So effectively, that 2.5% could get cut back quite quickly, and you're dealing with a 60%, 70% chance of actually making that money. It's 30% chance you get it wrong.
David?
You know what? If I was a betting man,
it's still positive numbers,
if I was a betting man, I mean, what you do is you actually lay your cards down when the deck is stacked in your favor. And I think there's enough evidence here that the deck's stacked in your favor that you can cover off your costs with these additional.
Okay, well, let's talk about another big one is the sell in May and go away. That's a common one. Some people play that game and they do quite well, and others disagree. Who wants to go first?
You want me to go first?
I'll go first. Sell in May and go away was actually it's European in origination. And it comes from the fact that a lot of the metal smelters were located in Europe. And essentially, once you get past May, Europe goes into holiday mode, and the production and everything would basically drop off until September, and up we go again once the holidays were over. But what's happened over the years is that actual smelting production has moved in a big part from Europe to South America and Asia. And so, it's not as relevant, but at one point, the investment news picked all this up and said, okay, well, let's just call it sell in May and go away and apply it right across the markets, when originally it was only meant to be in the commodities. So.
Are we seeing? Is it work? I mean, what does your book
so
say?
Here's what the book says. And so as an example, from 1977 to 2013, Jeff, if you had invested $10,000 in the TSX, just in the index, and you did it from May 5th to October 28th, you'd have a negative. And then, you went to cash between October and May. You'd have a negative $3,000 and change return. But if you had invested October 28th to May 5th, and you went to cash between May and October, you would have $202,000 and change.
Okay.
So then if you take the S&P 500, you take a longer term period from 1950 to 2013, 10,000 invested, you'd have negative $2,500 if it was in the unfavorable period between May and October, and versus you'd have 1.3 million in the favorable period.
Wow,
Okay?
that's significant,
Now-
Jeff. Rebuttal? It's hard to argue with those numbers.
I don't have this book.
The Bible.
I don't have the reverse book that gives me the other side. But as in all things, it's if you can do this consistently year after year, maybe it works. But the problem is everybody isn't in the same position. You retire today, you've got this lump sum of money, and let's say you caught the years it didn't work. Well, now you're down, and you're not going to see those years that it actually did work.
Okay, I'm going to save you, Jeff, on this one, because I do agree you need some discipline when you go ahead and do this kind of stuff, and technical analysis helps you on the entry and the exit of it, and I think it really does enhance it. Yeah. However, I'm going to take that back now and just say that 70% of the time the favorable outperforms the unfavorable.
So, that's a good number. That's a good. If
Yeah,
you're a gambler, that's pretty good odds, right?
Yeah, and actually gambling, if you define it as the expectation of a negative return all the time. So investing is the expectation of a positive return.
Yeah.
That's the difference between the two.
Except for maybe this year.
Huh? Oh, this year. Well, this year, another. Hey,
it's always the exception to the rule, right?
We should talk about that because right now, technically, the S&P 500 and
it's in correction mode, isn't it?
That's right.
Yeah.
It's technically it's broken through its 200-day and 50-day moving average, and the TSX year to date is down. Probably
17%. I heard or something.
well,
right?
it's not. It's down about 1,000 points because I looked at it this morning. Just from if we take December 15th to December 15th, right? And so the trend isn't looking positive. We've got a downward trend. Now that being said, as I had mentioned, this potential rally, today's the 15th. So, maybe all this reverses and
we need oil to rally for Canada's market, don't we?
That's exactly what's driving it.
Yeah.
What's driving the markets down right now is the Fed rate announcement, oil, and a strong U.S. dollar. All of that stuff is really challenging for it.
All right, we got a couple of rallies coming up. Let's talk about those potential rallies.
Sure. Okay. So two of them. One is oil, February to May, and the reason why that happens is because of inventories, and they get drawn down towards the spring.
And demand goes up.
Yeah, and that's right. And so for the price of oil, it tends to go up.
Yeah.
The other one is banks, and so banks tend to outperform typically Canadian banks, right, from January 23rd to April 13th.
Okay. Your thoughts, and maybe on a summer rally too?
My thoughts on the oil rally. Typically, why it draws down is you're in the midst of summer, in the midst of the winter, high energy use. We're looking at I can't remember, is it El Nino or El Nina? So we're talking about a warmer winter. We've got huge oil inventory, so the likelihood of that working. The summer rally, it's true. You will find 3 weeks in that summer period that would be deemed a rally and the market went up. You can do that in every other quarter as well, though. Yeah. There's nothing special about the summer, and particularly if you've actually sold in May and gone away, you're not around to do it anyways.
All right, guys, it's been a blast. It's great talking about this stuff, and it's nice to have the different opinions. And you guys can always find out more information from you on your website.
Yourlifeyourplan.ca.